Hello, my name is Nadia Sood, and I'm the CEO of Credit Enable. Credit Enable is a credit insights and technology solutions provider, and we basically build solutions to the world's biggest financial challenges. One of the things we're really proud of is our technology platform that allows us to help lenders underwrite SME loans very efficiently and quickly. And SMEs find exactly the right lender with the right product to help them grow. I'm so delighted to be joined today by Matt Gamser, the CEO of the SME Finance Forum, one of the world's experts on what helps SMEs to grow and the facilitation of digital finance to help those SMEs grow. Excited to be having a great conversation today about how digitization in the space of SME finance is helping fuel economic growth. This couldn't be more timely considering the challenges the whole world has gone through over the last year. Matt, I'd love you just to say a couple words about yourself, what the SME Finance Forum does, and then we'll launch into our talk. So great that you could join today. Thank you so much.
Thank you for having me, Nadia, and welcome everybody. I'm Matt Gamser. As you heard, I'm the CEO of the SME Finance Forum. The SME Finance Forum is a center for knowledge exchange and networking in the field of SME finance. Our goal is to help SMEs get better access to finance by making the industry that serves them stronger. And we do that through helping leaders in the industry learn from each other, link to new business and partnership opportunities, and to lead the industry voice in high-level dialogue with the World Bank Group, the G20, the OECD, and other important bodies that are working on creating a better enabling environment for innovation and responsible financing. The SME Finance Forum is managed by the IFC, that's the International Finance Corporation. It's the private sector arm of the World Bank, where I've worked for just about 16 years now, and for the last few running this new initiative for the G20. So that's where we are. We're very excited to be here and very pleased that Credit Enable is one of our members.
Thanks, Matt. It's really exciting to be able to talk to you today to see how do we look at this challenge on a global basis. You know, what happened before, what was happening before COVID, what's happened because of COVID, and what does the future look like? From our perspective at Credit Enable, we act like a hybrid between a credit educator that helps our borrowers understand their credit position, and then of course, improve their credit position and eventually take out the debt they need to grow. On the other side, we work with lenders on logistics, sales, and distribution just to make them more efficient so that they can underwrite quickly in this segment of the market, which has typically been very challenging to underwrite in a cost-effective manner. The obvious effect of that inefficiency in the market, which is something that the IFC and the SME Finance Forum focus on so much, of course, is that economies suffer. And we all know that, you know, anecdotally that SMEs are super important, governments always talk about them, but it'd be great to hear just some facts from you on just how big this problem is, how big was it before, what's happening now, and what could the opportunities be? So let's get a little bit stuck into some of those facts as well.
Sure. Well, let's try from the big picture first. SMEs have always been a challenge, a particular challenge for the financial industry, especially compared to corporates and consumers, because corporates are big clients and institutions have been able to deal with them by throwing people at them because they're big clients. They make big margins, you know, the big volume deals, which you can make big profits on, even if the margins are small, sorry, but you can afford to attack them with people. Consumers, on the other hand, more and more institutions have figured out ways to automate the consumer sector. And so that's enabled consumers to become another area that your conventional finance industry, banks and non-banks, have been able to understand as long as they have the basic infrastructure. SMEs, on the other hand, sit in between, and bankers have always struggled. They put them in corporate and they find that they can't afford the people time and still make any money off this group. And they try them in consumer, but the automatic nature of the data they'd had in the past has not been sufficient to really risk manage in the SME space. Now add to that in crises, SMEs always suffer hardest and often take longer to recover. And the fact that this crisis is broader and deeper, broader in countries and sectors, and deeper in that it's had things like lockdowns, you would think that it's really just a complete gloom and doom time. Now that's, it's not quite that simple a story, and I think there's a lot of grounds for hope. Before the crisis, we had estimated the gap in the market for credit for micro, small, and medium enterprises, just the formal ones in emerging markets, was over $5 trillion. If you look at other dimensions like the number of SMEs who are in structured supply chains and are owed by larger companies, you're talking about something north of $15 trillion of payments that are coming, but they're late. And they're later than the SMEs can afford, and they get SMEs in trouble. And pandemics like this further gum up the works in supply chains often. So these are big numbers. And before the crisis, we were already seeing some signs of hope because, as you said, Nadia, while there's still trillions and trillions of dollars that's done in cash business and in paper contracting around the world, we were seeing more and more movement into electronic transactions, both the money side and the contractual side. And if anything, the pandemic has accelerated this because the one unintended consequence of the lockdowns is that people that had been reluctant to go digital now had to do it to survive. So suddenly there's even more data. There's even more data in pretty easily retrievable form if you have the right access, and very rich data from the standpoint that it is very directly relevant to the risks and opportunities in financing SMEs. So this is all happening. We don't have an update on the gap. I would expect that the situation is still for the moment worse, but it's a little bit hard to tell because most countries are in payment moratoria, and a lot of institutions that normally lend because of payment moratoria are also slowing up a little bit in what they're doing. But we're hoping that we could come out of this bigger, faster, stronger with a better system. We are also seeing, ironically, because of lockdowns, that SMEs, that especially the ones that are less capital intensive, have been able to adjust their business models faster than, say, bigger companies and switch from, say, physical sales to online sales. Thanks to another development in the last few years, only this increasing pervasiveness of online marketplaces and infrastructure. Before, as a small merchant, for example, which is one of the largest groups of small businesses, I think in India alone, there are 90 million small merchants, something like that. You had to have people, you had to have footfall. People had to come to you. Today, there are alternatives for finding markets. And even if they come to you and they pick up things, they've arranged the transaction before because you don't want them in the store because you don't want to spread COVID. So, and that creates data. And so all this is really, really accelerating changes. And the other good news is that bankers too, because they're affected by lockdown, and non-bank financiers, they've also had to get with the program. Many of them had resisted. They had a 5-year digital plan. They had a 3-year digital plan. And these all became 3-month plans when the pandemic hit, because if they didn't become that, business was going to be stopped. So lots of things churning right now, lots of exciting developments amidst what still is a very difficult challenge, don't get me wrong. But we're seeing the ones that have embraced digital even thrive. Both the financiers and the SMEs that were very digitally friendly are actually doing quite well now. And we hope that this is going to give us momentum for the future.
It's so interesting that you say that because, I always think about SMEs as being the most resilient in a sense and the most nimble. And they have to be because it's a matter of survival, essentially. They don't have huge cash reserves normally. They don't have the ability just to sit still, do nothing, and wait out a storm. They have to move. And so COVID has been both an opportunity and, of course, a tremendous crisis, depending on how nimble or how adaptive you were. If you think about how much of GDP is contributed to by SMEs globally, and how much of an opportunity it is if SMEs can actually be the most nimble. And you can see that in every country, you know, in the UK where we are, where Credit Enable is, we see, you know, people completely reinventing their business model from being like a restaurant to then a deli to then an online deli, and figuring out how to go digital so that they can keep generating revenue even during a full physical lockdown. In India, we've seen people pivot completely from a certain sector into the healthcare sector or into the fast-moving consumer goods sector to meet the additional demand. You know, where do you think there are the opportunities for lenders and financial institutions, not only just to think about accelerating their existing digital roadmaps, but to actually start thinking about SMEs differently and start and capitalize on this huge systemic change to introduce new products? What do you think they could be doing to even fuel this resilient growth even more? Because at the end of the day, what's going to drive the UK economy, what's going to drive the Indian economy, what's going to drive economic recovery from COVID will be the SME segment. So it has to be financed properly.
So I agree with you completely that SMEs are very resilient. That's one of the greatest assets. Unfortunately, SMEs in the past got very little credit for this resiliency. And I mean that in the sense of finance credit, and they didn't get recognized also. Why? Because you know, you could be changing your business approach, you could be changing your product mix, you could be changing your customer marketing strategy. But when it was all on paper, the only way the bankers could know that is physically by sending their teams, their business banking specialists, to the SMEs to kick the tires and see what's going on. And sure, you can do that, but to keep up, and to keep up affordably, because you can't charge infinite interest rates to these people, it was just not profitable. And that's why very few institutions really scaled up this SME market very well. And so much of the business, as we said, with the 5 trillion plus, and that's just emerging markets and just formal, was left on the table. What's happening now is particularly promising because the major innovations all involve digitalization at the same time. So SMEs should, with the finance sector being on their game, SMEs, or helped by people like Credit Enable, they should be able to see what's going on. And it's going to become increasingly important to do that seeing, and also to change what have been the priorities of what bankers are looking for. I mean, historically, unfortunately, bankers focused on things like collateral, and in particular, they focused on fixed collateral, things like property, cash, land. The SMEs don't have this for the most part, and it's not a good indicator of the riskiness or the adaptability of the SMEs. On the other hand, movable items, particularly in this case, inventory, assets that are being bought and sold, accounts receivable, things like that, this is very valuable. And looking at how those movements are happening and what patterns are emerging, who are the customers, how regular are the customers, this is telling the financiers that are being sharp a lot more about risk and potential. You'll find SMEs, you'll find the ones that have regular customers, regular suppliers, and that are keeping that regularity now because you're getting real-time data. And you'll find the ones that are more disrupted. And so you can work with them appropriately. And that involves not only lending and lending more to the ones that show all this resiliency, but it's about having guidance for how you can work through the issues with the ones that are having problems. Yes, some will fail, but you don't want them to fail because the banker took the wrong steps in managing the portfolio. So it's not just about new business, it's about managing the business that there is better, and all that is possible with these data flows. And all that is possible. It used to be only these unconventional alternative financiers and maybe a few rare bankers that were getting in there, but now more and more from all walks are looking into these areas. So it is encouraging, but there's a long way to go. I mean, as I said, it's not a rosy scenario, and it's a big mind shift to get bankers into looking at this, and hopefully they can do it through partnering with tech partners who can give them this greater analytics capacity. Lots of things churning, and hopefully we will come through this with much stronger in the field.
Yeah, one of the most amazing shifts I think that's going to happen, which will be around finally getting some more inclusionary behavior in the financial services sector, is that data can expose, of course, where the risk is, but also where the opportunities are. And like you said, one of the things we really are passionate about, obviously, is trying to find ways to help include people who've otherwise been excluded simply because the data wasn't there on them, not because they were actually not creditworthy, not necessarily because they were unbanked, but women, for example, who traditionally and statistically globally have less access to collateral, to fixed collateral, than men, simply because of property law in different countries and just history, now no longer matters as much, because, as you said, if the client has regular customers, if they're getting paid on time, if their online transactions are going up every month, then the fact that they don't have the collateral becomes less important. And suddenly a whole group of entrepreneurs who was otherwise excluded from securing the debt capital that's really mostly necessary in order to grow can avail of that. Likewise, geographically marginalized people, any kind of minority anywhere in the world who might have been excluded for whatever bias, there's an opportunity for that no longer to occur, provided that we actually start looking at things with a different lens. I think there's a huge opportunity for cash flow based lending, because now you can see what the cash flows are. So one thing I'm curious about, though, is that, at a disaggregated level, SMEs are, they're not consolidated. They don't act as groups. They're one-on-one and one-on-one, and they're a little bit hampered by their size because they don't have muscle. At an aggregated level, they represent a massive opportunity. And so what more could government be doing to help aggregate SMEs into one body? Some of the things I think about are, open banking holds that potential, because if you get an open banking regime set up like the UK has done very successfully and is now a model for other countries, suddenly that group of 5 million or so SMEs that exist in the UK, which makes up 98% of companies almost, is no longer having to be looked at one-on-one basis. They can actually be aggregated, and data analytics can be run on a whole group of those companies at the same time and in a cost-effective manner. We see the move to open banking happening in other countries. India is looking at a similar type of regime through the Ocean regime. But what else do you think, given your experience, could be done more by regulators to help SMEs actually generate that muscle that they actually have when you aggregate them? And what do you see happening on the financial services side? If you could think of 2 or 3 fast movers, innovators that are doing very cleverly to address this.
So let me get to that. I just wanted to reinforce your point that, in aggregate, there's a lot of business there, and there's particularly businesses from niches that haven't been adequately served within the SME sector. And there's powerful financial incentive because the margins are bigger for SME. In corporate, the margins are, everybody has gone for the corporate, and there's more and more competition, and the banks get competed by the capital markets the more the capital markets develop, so the margins just go down. Consumers, you know, in many emerging markets, there aren't that many people with regular salaries. So it's not as big a temptation as it is in rich countries. And even there, it's very, very competitive, and, you know, margins are small. But SMEs, they had not been served well. So you can get good margins. And then you go to groups like women, who we know from statistics, they're not only better credit risks on average in small as well as micro enterprises, but they take more cross sell. They do more referral, both to their employees and to other peers in business. You know, they are, and this is when you compare them one-on-one with men in the same business, right? But they're still historically, you know, way down from numbers of business versus access to finance. And I would make the same case for most of agricultural finance, because it had just been too hard to understand the risks going on and from field to fork. But now with Internet of Things, more and more of these can be managed. So now what can governments do? I'm a big fan of what most people call open banking. I think it's an unfortunate term, because we don't just need open banking, which in many countries means the regulated banks have to make the transactional data available for an individual who agrees to share it with whoever they're applying to credit for. We need the data from all the major transactional processors out there. And all that needs to be open. We need to have an infrastructure where it can be pooled with the individual identifiers taken off, so that anybody who goes into the reservoir who has permission can't just go on fishing expeditions and steal everybody else's clients, or even worse, invade people's privacy. But we need that data to be there, and everybody needs to contribute to it. And unfortunately, what's mostly called open banking, it doesn't have contributions from many of the alternative sources of data that are becoming increasingly important, like the alternative payments processors, like the alternative lenders, like someday some of the other data that's coming from social media that's more qualitative, because more and more businesses are using social media to do their marketing, and now payment is connected to that. So, and you could look at customer ratings and things like that. India is trying to create a public infrastructure that's going to permit all this. And I think that's really exciting. We may see yet again, as we saw in microfinance, India being the tortoise to some of the rest of the world's hare, and it's steadily plodding along, and it's doing these long-term investments, and I think they're going to pay off. Will other countries do an India stack model? I don't know, but they should think about what they can do in promoting infrastructure, and whatever they do, they have to look at data governance and try to make sure that there's some equity in terms of who has to contribute what, and that there's some system that they've agreed on, at least within their own country, where they can get this anonymization of the pooled data coupled with the security of the personal identifiers. It sounds a tall order, but the technology is all there. It's about getting the institutional and the political will to make it happen. And that's always the challenge.
Yeah, no, I think you bring up such an excellent point, and it's kind of such a nice way to lead into our finale or conclusion for this talk today. But I think it all comes back down to the SME as a unit is a fantastic generator of wealth. Once you aggregate it up, it becomes a fantastic generator of economic growth, of GDP wealth for an entire economy. And it struggles to get its story understood. With these new data frameworks coming into play, even though they are, in some cases quite narrow, with broader data frameworks coming into play, like the Indian framework, the India stack, and then the further articulations of that will allow for aggregation of lots of data from different sources. And with technology, there's a higher likelihood that SMEs will start to get their just desserts, get what's due to them. And hopefully this opens up a huge opportunity for financial services players that they've known anecdotally to be there, but not been able to really tap into. So I just want to close on some interesting numbers and see if you could help me fill this out for our audience. But globally, every year, according to the IFC World Bank research, which is the preeminent research on this subject matter, there's $8.1 trillion of capital available to lend to SMEs, and yet $4.5 trillion of that just isn't getting dispersed, which, as you think about the size of the prize for anyone wanting to go after that, that's a far bigger marketplace than Amazon. And so if you can get into that market and unlock that $4.5 trillion, how many jobs would we create on the back of that, Matt?
Well, the numbers are, they're going to be high, because if you look at percentage of employment, you see that SMEs in most countries represent the majority of jobs, and the poorer the country, the higher the majority share. So the more you go into supermajority, the poorer the country is. Now, what we're seeing is this opportunity, right? But at the same time, we're seeing that just looking at it as a financial problem is not going to get us there. I mean, that's the one thing I want to leave you with, because it's not just getting the transactional data into digital form. If all you're doing is digitalizing what's already there, there's going to be limited upside. If, in addition, you look at that SME's wider ecosystem, and that ecosystem has two other legs to this stool, of which finance is one. The second leg is about markets. Most SMEs deal in very poorly structured markets. They kind of sit back and wait, and it's kind of random who buys from them and who they might even buy from. You need to put more structure into the marketing side, which is also doable digitally and is happening. And then finally, you need that SME to be better run, to have better information in the entrepreneur's hands and better education in the entrepreneur's brain about how to look at what's going on, not just the finance, but also the markets, the employees. And that is also with the advent of cloud-based business solutions, which are paid for by subscriptions and not by expensively having to buy software that's out of date by the time you've figured out how to operate it. This is all potentially changing the world and making more of these SMEs part of structured systems that really have more stability, therefore less risk, more upside potential. And so you're going to make not only more SMEs bankable, but more of those SMEs that are bankable are going to have lower obstacles to growth. We may still see that a lot of them don't grow a lot, but all we need is a marginal improvement in how many grow a little or how many don't fail. And the impact of that on employment, on incomes, and on business for financiers is going to be substantial.
Yeah, absolutely. So, if you think about it, if we unlock the $4.5 trillion, the minimum number of jobs that would be created would be 4.5 trillion. And if you think about then that those companies receiving that finance were also benefiting from the broader innovation around technology to getting better real-time information for themselves, participating more in those markets, it might be a 10 times multiplier of that even. So it's a fantastic way to end off, I think. I'm excited about the potential. I think there's so much more to do, of course. In the UK, where we operate, in India, the struggle is not over. The pandemic is still having a significant impact on lots of sectors, and of course, disproportionately impacting on women who have been, again, huge participants in the tourism and hospitality sectors, which have been very badly hit by COVID. But I think on the positive front, the trend towards digitization and the harnessing of data that opens up whole new possibilities for this segment of the market. We couldn't be in a better position today than we ever have been. So the future, I hope, is bright. And I'm delighted to have been able to talk with you about that today, Matt. If you want to learn more about Credit Enable and our activities, you can visit us at www.creditenable.com or find us on LinkedIn under the same name. And Matt, if you'd like to do the same, then they'll know where to find you.
Sure, you can find me at the SME Finance Forum, which is www.smefinanceforum.org. We also have a LinkedIn company page by the same name and a discussion group by the same name. And if you want to be in touch with me directly, you can find me at mgamser@ifc.org. It's been a real pleasure talking with you, Nadia. I really do think we're in a challenging time like none of us have ever seen, but at times of great challenge, there's also great opportunity. And as you were saying, this is a real chance to change the game for small businesses and to really help the world by doing it.
Thank you so much, Matt.
My pleasure. Thanks.